Hi, good morning. Today I'm going to be talking about active versus passive investment management strategies. My name is Tanu Signani and I will be presenting along. So the first thing I'm going to be talking about is active investment strategies. This is a much more hands-on approach. This basically means you have to hire a portfolio manager, or you could do it by yourself, and you buy and sell stocks to earn a greater return compared to an index fund. An index fund is something such as the S&P 500. The goal of the manager is to follow market trends, changes in the economy, as well as changes in political situations and any other key factors that could influence the movement of the stocks in your portfolio. The second goal of the portfolio manager is to pick undervalued stocks that generate a greater expected return compared to stocks on the equilibrium on the security market line and pick the right stocks. This basically means that the portfolio's manager's job is to pick stocks with a positive alpha and sell stocks with a negative alpha. This leads to capitalizing off market inefficiencies, and we're going to discuss the efficient market hypothesis later when we discuss passive investment strategies. Now we're going to be discussing advantages and disadvantages. The first advantage we're going to be talking about is about how extremely flexible an active investment strategy is. This basically means you can buy and sell stocks whenever you please. So suppose if in your portfolio you have Disney and it goes down by 15%, you can sell that stock immediately. But if you're in a passive investment strategy, you have to keep that 15% fall. The second advantage means you have a greater variety of trades. The first one is short selling and the second one is option trading. This basically gives you the opportunity to create a greater expected return. The third one is managers can take advantage of market inefficiencies. Now we're going to discuss the disadvantages. It is much more risky. If managers take the wrong stock or short sell the wrong stock, this means you can lose a lot of money in your fund. The second disadvantage is that it's very expensive. So hedge funds typically take 1.6% of management fees of the fund you generate, of the fund you deposit, and 17% performance fees. So if you generate 40% off the hedge fund, they will take 17% off it. Smaller funds take up to $1,500 to $2,500 or 1% of the fund that you put into it. The third disadvantage is you don't really know exactly what's in your portfolio because the manager keeps changing it. So this is a real world example. This is Takashi Kotegawa, and he turned $12,000 into $1.65 million in 4 years. He made 33% of his money per year. The S&P averages 10% return per year, and if he invested his $12,000, he would end up with $18,000 at the end of the 4th year. This just shows the disparities if the markets are inefficient and how you can capitalize off it. So now we're going to talk about passive investment management. So this investment management strategy is creating a mutual fund or an ETF that is very similar to a already existing index fund, and it matches or is very similar to the returns of that index. So the goal of this strategy is to buy and hold stocks for a longer period of time compared to an active management strategy. So if a stock falls by 10%, you still keep it and you wait for it to go up, or you just ride with the stock. So this reduces the risk of making a wrong decision. So suppose you short sell a stock and that stock keeps rising up, you avoid that risk. This is a great way of mitigating extra risk and gaining a positive alpha that is similar to the index. And according to efficient market hypothesis, passive investment is much better than active investing. Because over the long run, active investors might make a gain in the short run, but over the long run, passive investment will be better. So now we're going to talk about some advantages and disadvantages of them. The first one is performance is aligned with the index. So there is opportunities where you can beat the market or get less than the market, but regularly your performance will be in line with the index, which is great because you always make the same amount as the index. So there is transparency of information. That means you always know what's in your portfolio, how much quantity of a stock you own. The third advantage is low fees. You don't have to hire a portfolio manager. This reduces overhead costs greatly. So now we're going to be talking about the efficient market hypothesis. So this represents that all information is available and all of information is relevant in the market. So this suggests that active investing trading, they can make a gain in the short term. So for maybe 1 year, 2 year, 3 year, but over the long run, passive investment is better. You'll make more money off that. So now we're going to talk about some disadvantages. So if markets are inefficient, then this is quite a limited gain compared to if you pick the right stock. Another disadvantage means that holdings are locked in place. And this correlates with the next point as well. So if the market goes down by 10% and your stock represents the same as the index, your stock portfolio will fall by 10% as well. So you're basically copying the index. So to summarize our points that we talked about, active investment management works better if there are market inefficiencies, and passive is better if the markets are efficient. So now we're going to be discussing some bonus information. So today there are a number of fintech companies such as Robinhood and eToro that allow you to transaction and trade for zero transaction fees. These apps also allow you to copy investors, so copy active traders, and this basically reduces a lot of the costs that were associated before with active trading. So this helps to capitalize off the inefficiencies in the market nowadays, and these apps do make money off the spread. So as in you still have a tiny transaction cost, but it's much less compared to before. Thank you.